Hello, everyone, and thank you for joining today's panel discussion, the last panel discussion. My name is Sunshine Kim, and I'm with Radius. I'll be moderating today's session. Our topic today is the institutional-friendly layer, Layer 1 versus Layer 2. Institutional interest in crypto has grown rapidly in recent years, yet key questions remain. Which blockchain layers are truly ready for large-scale institutional adoption? And how can we balance the principle of decentralization with the growing demand from institutions? We are fortunate to have leaders here today from Layer 1 and Layer 2 projects. Together, we will explore what an institutional-friendly layer really looks like and where the future of blockchain infrastructure might be headed. Before we dive into the discussion, let's first meet our panelists. I'd like to ask each of you to briefly introduce yourself and your team. Let's start with Omar, then Mark, and finally Mo, please.
Hello? Oh, there we go. Okay. It's on. Yeah, Omar Azhar, Head of Business Development at ZK Sync. At ZK Sync, we are building Layer 2 technology specifically for institutions, private Layer 2, such as Providiums. Comes in with all the different compliance, KYC types of features that institutions, banks, governments need to be able to build their own operating environments as a Layer 2s on top of Ethereum. Things such as selective disclosures, things such as fine-grained access control. It's a very pragmatic approach to essentially building institution and execution environments within the Ethereum ecosystem.
Mark?
Hey, my name is Mark, and I'm from Optimism, and we build the OP stack and the superchain. And the OP stack powers the majority of L2 transactions on Ethereum today. So we're working hard to bring more institutions on chain, whether it's centralized exchanges or TradFi, or really anybody that wants to run their own blockchain. We're here to help bring you on chain.
Hey everyone, my name is Mo. I work at the Ethereum Foundation in the enterprise team, so I'm the APAC enterprise lead. Prior to being part of this team, I used to work in the cryptographic research lab at the Ethereum Foundation. It's focused on ZK, one-party computation, TEs, that kind of stuff. Yeah, really looking forward to today's panel.
Thank you for introducing. We got a sense of who we are talking. I mean, who we are. And so let's start with the first question. The concept of the institutional-friendly layer is crucial, but what does it actually mean? Beyond performance, what essential elements must be included? And within that framework, between Layer 1 and Layer 2, which do you see as more suitable for institutional adoption and why? Could we start with Mo from Ethereum Foundation?
Yeah, so we spend, at least in my team, a lot of our time talking to large financial institutions. And I think from the point of view of the Ethereum Foundation, we see that Layer 2s are incredibly important to the ecosystem. The Layer 1 is a place for settlement and potentially data availability. And the Layer 2s are really a place for execution, to tailor your experience to what you require, whether that's privacy expectations, compliance, all those various different things. So yeah, I think Layer 1 as the place to settle, and you get economic security, and Layer 2 is for basically everything else.
Yeah, thank you for your opinion. Even within Layer 2s, we see different approaches. Optimistic rollups like Optimism and ZK roll like ZK Sync. As you each look to attract institutional adoption, what do you see as your differentiated strategies, Mark?
Yeah, good question. So really, there's a bunch of different blockchain frameworks today. And I think one of the core differentiators is the security properties, in the sense of how Lindy is the chain, how battle tested is it, how much usage has it gotten, how many times has it been pushed past its limits, and how many bottlenecks have been addressed. And today we are pushing the limits of the OP stack. It has been being battle tested in production at its limits for quite some time. And we're constantly finding new bottlenecks, working on addressing them, pushing the limits. So if we look at institutions today, the amount of usage that they have is way larger than what happens on chain on a daily basis. So to be able to support real world usage, we talk about bringing, Wall Street on chain. There's no way that the existing chain infrastructure could support that. So we need to keep pushing the limits, and we need to, we have the OP stack where it is battle tested, and we're continuing to improve its throughput so that financial institutions feel comfortable coming on chain because they know that the infrastructure that they're going to be using has been battle tested and it's constantly getting better.
Thank you. What's your opinion, Omar?
Yeah, so for us, when I came on the scene about 3 years ago, our biggest focus at that time, we had identified, it was still very early, but we knew that going after financial institutions, banks, central banks, governments, etc., would be the key turning point for crypto in general. And at that point, there were still very much a lot of discussions around things like an institutional focus layer 1 versus why should we build on Ethereum versus not. And so we spent a good number of years just going around to different banks and talking to them about the differences between, hey, the consortium model, we've tried that before many times. It does not work. You guys do not trust each other. You do not want to trust each other when it comes to different trades. There's no different than what the current legal structure that you guys are already building on. With Ethereum, at the very least, code is more or less law. You know what to expect based on the protocol. There is no single entity you can go and sue, which is not the same case if you build a consortium layer 1. There's always going to be some entity you can potentially try and sue, and then you get wrangled in mostly those types of discussions. And so we finally got around to finally convincing a lot of these banks just be like, okay, Ethereum is a neutral settlement layer because it's fully neutral. There is no single entity that runs it. So all of you can trust the other operating on top of it. And that's where the layer 2s then start coming in. Okay, each of them will need their own operating environment. Maybe many of them will probably need multiple operating environments. You'll probably have operating environments based on different jurisdictions as well because of data privacy and all those things. And so for us, we've been very focused on building very specific products, such as Providium, for institutions with different things such as selective disclosures, the ability to set role-based access control. You can, pretty much everything that they are currently used to, from how they control and access data, how they control who executes transactions, et cetera, within their environment. That's all built in within the product itself, rather than having to think of it as add-ons. So for us, it's, Ethereum has a very neutral settlement layer and also has the asset issuance layer. And then for everything that institutions need to do, they have their own fully private layer 2 environment that they control everything on.
Yeah, thanks for the valuable talks. The real question may not be about where innovation starts, but how quickly it can be adopted across the ecosystems. At the same time, there's also another category we shouldn't overlook, permission layer 1s, such as Google Cloud's Universal Ledger or Canton Network, where trusted institutions participate or are expected to participate as validators. Can we start with Mark this time? How do you view the role of permission layer 1s in the broader landscape? Are they complementary to permissionless layer, like Ethereum and ETH2, or fundamentally different? What do you think?
Oh, great question. So
I'll pile in.
I think that a lot of people in the community, if you were relatively early to the crypto space, you probably are philosophical about decentralization, thinking it's really important, which I totally agree with. I think it's really good, but we need to take a step back and realize that not everyone in the world is philosophically aligned, and people aren't going to just use Ethereum because it's decentralized. There needs to be true value propositions behind it and driving the reason why people choose Ethereum over an all-L1. So decentralization needs to be an obvious value proposition. It can't just be because decentralization. So I think that people should never hate on someone for them following their own best interests. If it's in the best interests of a company to go with an all L1 because Ethereum and the L2s didn't solve the customer problems, then that's our fault and we need to be better. So I think that as the Ethereum community, we need to kind of look at the recent projects that chose to go with all L1s, and instead of complaining or being upset and yelling at them for being centralized, we need to introspect and ask, what value propositions does an all L1 have over Ethereum and an L2? And how can we bring those value propositions to Ethereum so that the next round of customers that are interested in coming on chain will come to Ethereum and the L2 ecosystem rather than an all L1.
Yeah, thank you for your feedback. And Omar, this raises a question directly for you. You are building both permissionless infrastructure and also Previdium, which is more permissioned and institution-focused. I'd like to hear your opinion about this.
The permission versus permissionless?
But at the same time, what do you think is the role of the permissioned L1? Because you are having both, so I think you might have a different opinion.
So it really depends, right? I think if you're building something that's closed loop, then just build a permissioned L1, just build a database, right? But for finance use cases, for payments, etc., those are not closed loop environments. They are connected to literally every other facet of everything else. And so you are going to have some element of coordination involved. And one of the biggest breakthroughs of blockchain and decentralization it's a means to trust automation, not having to trust intermediaries, not having to trust different types of social constructs or legal constructs to move from one point to another point. Blockchains, through decentralization, essentially remove a lot of that. And so this is where, if you are going to do an L1, it either has to be fully decentralized, where you know and can fully expect what is going to happen with each type of transaction, which is when you operate on something like Ethereum or even one of the other decentralized L1s. You understand, okay, these types of transactions go in this way, this is how the network behaves. With permissioned L1s, though, that's not really the case. And because it is permissioned, there is liability involved in some way, shape, or form. And once you include liability for a particular actor, it completely changes the very nature of expectation. And now you are starting to bring in trust in a intermediary sort of way. So I think even, yes, we can say decentralization, not decentralization from a philosophical standard. I think also from just a practical standard. We have seen from the last couple cycles, the permissioned consortium-based L1s have never really worked. They've never really gone through a full cycle. And that's why a lot of these institutions now are saying, okay, start thinking about layer 2s or just fully permissioned L1s that aren't even decentralized for that matter.
Yeah, I know you didn't ask me the question, but I just want to jump in there. Fully agree with both Mark and Omar on this. Over the last, I'd say, 2 months or so, we spoke to hundreds of institutions. And ultimately, it comes down to, them trying to find the best solution for their problems. And what we found time and time again, conversation after conversations, institutions care about not just necessarily the values of Ethereum, but how do those values translate into business values, economic values? They care about liquidity. They care about the fact that no one can turn off the network. They care about the fact that, if they have, for example, a technology provider like AWS, 99.6% uptime, Ethereum's been up 100% over the last 10 years. Those are the things that they care about. And what we find is that actually oftentimes when people choose an ecosystem, part of it's not having enough knowledge, not being known about what's available. And I think that's definitely a gap that we're trying to kind of bridge. And yeah, to that point, like, there are obviously alternate ecosystems that you can go to, but there's one here, and it kind of does basically everything that you need to do. Maybe just need some guidance.
I really want to know what, yeah, later we will talk about the future, your roadmaps, but I'd like to hear things about like that. Things about the roadmap from that kind of perspective. Later. Later, okay. Sorry. So, is there anything that you want to add from here, the discussion, or shall we move to the next one? Okay, okay. So, my next question is, Paradigm's co-founder Matt Huang recently argued that to ensure neutrality and reliability in a global payment system, an independent layer 1 with decentralized validators is more suitable than an L2 with a centralized sequencer. Sorry. This was part of Stripe's decision to build an N1 called Tempo. From your perspective, how do you respond to this argument, Mark?
So, to me, when I hear Matt Huang talking about decentralized validators versus a single sequencer, it really comes off to me as kind of divisive political speak, because to me, decentralized is a subjective term. We're not really sure what his definition of decentralized is, and everyone has a different definition. So when people argue about whether or not a system is centralized or decentralized, 99% of the time, they have different definitions and they're arguing past each other. So it's not a very constructive way to communicate. A more constructive framing would be talking about a particular property that falls into like the framework of decentralization that you can begin to try to quantify. So an example of how to do this would be saying, we can talk about censorship resistance, because censorship resistance is a decentralization property, and we can begin to make a more apples to apples comparison of the censorship resistance properties of a system. So if we look at a L1 like a SWI, the SWI blockchain had a hack this year, and all of the validators were in a group chat, and they decided to start censoring the transactions of the hackers. So whether or not, maybe it's like a good thing to prevent crime from happening on chain, I'm not going to argue with that, but the definition of crime can change, from today to tomorrow, and we have no idea what the definition of crime will be tomorrow. It could just be moving funds out of your bank into another bank or buying something. So there are genuine risks when it comes to censorship resistance. So I think the question to ask is, how is the censorship resistance properties of an alt L1 versus Ethereum or its L2s? And if we look at the OP stack, the OP stack inherits the censorship resistance properties of L1. As long as you can land a transaction in L1, you can land a transaction into an L2 that's built on the OP stack. So if we're talking about censorship resistance, high chance that an OP stack based L2 is going to be more censorship resistant than an all L1, no matter because an all L1 is not going to be as censorship resistant as L1 Ethereum. So when we put it into those terms and talk about concrete properties rather than this word decentralization, which is a religious term and it's objective, everyone has a different definition, it's impossible to have a straight conversation when talking in terms of decentralization. We can reason much more realistically about these systems and have constructive conversations.
Thank you. And Omar?
Yeah, no, I think that's a pretty good way to look at it. I think another dimension here is since I think the topic of payments in blockchains has also come because in the traditional world, there is the concept of a reversible transaction. That doesn't necessarily exist in fully decentralized, censorship-resistant blockchains. You can't necessarily reverse a transaction. In the regular world of payments, with all different payment providers, vendors, merchants, etc., reversible transactions are needed for things such as fraud. If there is a, let's say, a merchant fraud that involves, or I essentially stole someone's credit card, the person whose credit card got stolen needs to be made whole. These are all types of transactions that current blockchain systems do not necessarily allow for, really. And so I think another dimension, the way to look at it, is to do things like reversible transactions and to implement things such as fraud control. You do also need an element of control over your layer one, and that's kind of another element for how they're probably thinking about it too. That just wouldn't be really feasible in like L1, Ethereum L1. You would have to come up with entirely new frameworks for payments in general.
What about you, Mark? What more?
I don't have much more to add than I don't really have much more to add than both what Omar and Mark have mentioned. I think Ethereum and its L2s offer a very strong proposition for financial institutions. And again, decentralization is something that's more of a concept, and you do have to agree on what you mean by that. But yeah, not much more to add, to be honest.
But actually, I found out that in case of ZK Sync and Optimism, you have the roadmap with the decentralization. Do you think that in the future, finally, the institutional companies will require for you to have the decentralized sequencing system, or what's your opinion on that?
Yeah, great question. I think that it's really, we have to talk about product requirements and understanding the problem that's being solved. And if an organization has the product requirement that they need multiple entities that take turns adding blocks to the chain, then that's definitely a feature that we can explore. I think one thing that we don't want to do is we don't want to build features without having users that are asking for them, and we don't want to build features that aren't solving problems. So really knowing the problem statement in the product requirements is key to understand how to decentralize the sequencer, because just saying decentralize the sequencer doesn't really give a clear product requirement. It doesn't describe what problem is being solved, and because there's lots of ways that you could technically decentralize the sequencer. So I think it's really about digging into the problem that needs to be solved and then coming up with the right solution for it.
And do you want to add something more?
Yeah, I would say we have not seen any demand for decentralized sequencers by institutions. They all want to run fully private, fully permissioned, single operator layer 2s with interoperability. In fact, we've actually seen demand for the ability to horizontally scale an execution environment. So let's say, ZK Sync right now could support 10 to 15,000 transactions per second, but in certain cases you might want to, horizontally scale and add more. So you would need some sort of interoperability layer as well built on top of that. Instead of decentralized sequencer, I think one thing that has definitely come up quite a bit is the view into upgrade process. Emergency upgrades, security upgrades, as well as just overall roadmap and when do different parts of the roadmap go for the upgrade, what is the review cycle. We are actually seeing quite a lot of interest by institutions being more part of that entire technical upgrade process, because for them it's almost like a software update, but very significant because this software also controls their assets. So rather than necessarily a decentralized sequencer, what they want to see more of is transparency into the protocol upgrade process, the security councils, governance, etc.
Is there anything that you want to mention about Mo?
Yeah, so I think two things. I think the first thing is that we definitely look at, for example, the various different stages of an L2, like stage 0, stage 1, stage 2. You can see this in L2 beats. it's nice to have a layer 2 move through the various stages and become quote unquote more decentralized. But I think generally speaking, it's as long as like users have an escape hatch to the L1, then it's great to be able to have options around performance, privacy, and kind of taking the various engineering trade-offs that you might need to get that. So yeah, I think like decentralized sequences, could be definitely a good thing, but there are reasons why maybe a user or institution would choose not to.
Just one thing. Maybe not necessarily decentralized sequencer, but something like 2FA, having additional full nodes that also verify transactions. So maybe like a third-party regulator entity or maybe the trusted third party is also there to additionally verify transactions. We've seen needs around that rather than just full stage 2 decentralized sequencers. Yeah.
Okay. So, okay, then looking ahead, okay, let's go to the next one. Looking ahead of the next 2-3 years, what is your roadmap for making your layer more institutional friendly? This could include partnerships, regulatory engagement, or technical priorities. Shall we start with Mo? And yeah, Omar and Mark, please. Up to you guys.
Okay, I can just go first. So I think on our end, I think making the base layer Ethereum L1 more lean, that lean Ethereum roadmap is important. Making it so it's more performant, so then L2s can inherit those benefits as well would be amazing. Those are definitely things that we're working on. Building, we already have a great relationship with all the layer 2s, building like a stronger connective tissue with them, and working on like ecosystem-wide initiatives that benefit everyone. So the Ethereum Foundation went through a very large change earlier this year. We have more dedicated ecosystem teams, institutional team being one of those. So for us, like when we think about roadmap, at least on like the technical front, it's like, let's make this leaner, let's make this, kind of like more efficient, more performant, and let's work with all the various different stakeholders to kind of push Ethereum forward.
For us, I would say 2 things that I'm really looking forward to over the next 3 years. One is fully private, atomic and composable interoperability between all the ZK chains in essentially under 1 second interop. And then also significantly faster finality on the L1. I think as Ethereum gets much, much faster, that'll enable us to build applications that directly leverage capital and liquidity markets on the L1. So for example, we probably don't need to build a large lend borrow like Aave or Morpho ecosystem within our L2s. We can just build a capability for anyone to access the collateral lending market already on L1 and take advantage of it that way. So I think with the faster finality, that opened up a lot of avenues for sharing the actual DeFi applications and liquidity that are on L1 as an L2.
Or is there any regulatory engagement that you're preparing now?
Regulatory engagements, can't really say, but I would say tokenized deposits are very hot. I think FOMO is an amazing thing in the financial industry for tech transformations.
And what about you, Mark?
Oh, there's a big roadmap here. There's so many things that we need to do. First thing that comes to mind is throughput. Just being able to vertically scale a chain so that it can be more performant, push that gas limit, gigagas, teragas, just lots of transactions, high throughput. Then there is interop. Interop is really important. Being able to horizontally scale block space. The way to think about interop, in my opinion, is the move from a single core CPU to a multi-core CPU. Blockchains are inherently single-threaded. There's this global lock over the chain's state that a transaction takes before it executes. And it's really difficult to break that inherent bottleneck. So interop lets you connect multiple chains together as if they were a single chain. And you can prove it as if it was a single chain. And the fork choice rule, like the reorgs, are aware as if it was a single chain. So it lets you build these cross-chain transactions very easily. Then the problem becomes, how do you build a simple and intuitive API for developers to build applications that horizontally scale? Because in the existing Web 2 space, things like Kubernetes exist, where developers just know how to scale their applications in the cloud, and these problems have just been solved. In the Web3 space, this doesn't really exist yet. It's a pain to develop an app. There really isn't a standardized way to horizontally scale your smart contract system. So figuring out the intuitive developer APIs and the standard libraries for building horizontally scalable applications is really important. And we believe that in the future, it'll be as easy to horizontally scale a blockchain application as it is to horizontally scale a cloud application. So there's a lot of infrastructure that goes into this. And then there's a lot of just developer tooling. Smart contract wallet adoption. I think a lot of the bottleneck to adoption today is the number of clicks it takes to do something on chain. We have to get it down to just 1 or 2 clicks. I think that this is possible. EIP 7702, being able to install a smart contract wallet at your EOA. I was really hoping that it would get more usage, but so far, not as much as I would like. It's been mostly used for crime, literally getting your funds stolen by signing a phishing transaction. So yeah, we have to make smart contract wallets really good, give fine-grained permissions so that you can enable automation to act on your behalf in very particular ways so that we up-level the user experience of coming on chain. Yeah, those are my thoughts right now. The roadmap is way bigger, just kind of shooting from the hip. We can chat more later.
Thank you for all the opinions. Is there anything that you want to add more? Yeah, yes, please.
I have so many questions, but I don't know how much time do we have? Hot take or like without any filter, I'm very curious what institutions are asking. And like when we sit in front of institutions, like what are the questions that they're asking us and what are the questions that we're not giving like a solid answer and they choose to like just go and build their L1s? Like what are the hard questions?
Yeah, I think one that we experience is faster finality. A lot of institutions are concerned about how long Ethereum takes to finalize. You can technically build an L2 that has a confirmation layer that finalizes faster than L1, but then it's kind of like, why is it an L2? Then you got to get into product requirements. Maybe you want the censorship resistance of L1, and maybe you want the permissionless bridging that comes with being an L2. Another one is confidentiality. Another one is gas abstraction, or like pay for gas with any asset. It turns out that the whole ERC 4337 paymaster sort of scheme isn't working today because it's additional infrastructure. And oftentimes, it's more expensive than you would think to run a chain. You have to pay for a block explorer. Then you want to bring DeFi apps onto your chain. So those DeFi apps all have required developer tooling that needs to exist. So things like Tenderly, then things like Gnosis Safe, things like custody, and all of those might have their own dependencies. And then all of a sudden you're like, okay, wow, I'm paying, 7, 8 figures on all of these companies to come deploy their software on my chain before I can even get applications to deploy on my chain. So it just creates this huge, cost. And yeah, I would definitely recommend looking at the white papers for both Circle and Stripes chains. And all of the features that are not in Ethereum are things that those are product requirements that they needed.
Recently, I've been asked a lot of times, are you SOC 2 compliant? So now one of our protocol engineers is going to start building that out. Yeah, it's a lot of what he essentially said. I mean, the way to look at it is these are systemic, or these are eventually going to become systemically important financial infrastructure. And so that means it has to go through the same rigor that banks essentially have to go through to ensure data secrecy, data compliance, travel rules. How do you actually implement travel rules inside the transactions, right? Like you have to add in a whole bunch of metadata. ISO 2022. And so all these things that we in the crypto native world never even think about, all the different compliance aspects, all the different additional metadata rules and checks that you have to implement. We get asked a lot of questions in terms of how would I build this into the system that I'm deploying. And then also, how do and then privacy and then security around that privacy comes quite a bit as well. And then scalability, horizontal scaling, etc. But that's generally it. I mean, it's starting to become very, very. These are all good questions that we get asked because it shows the maturity level that we as an industry now have gotten to, where institutions are looking at, essentially deploying significant amount of capital, and they need to make sure that there's multiple layers of security and compliance built into the infrastructure at both the core blockchain level, as well as the team that is servicing the blockchain. Protocol upgrades are done through governance, fully on-chain voting. We're getting asked quite a lot of questions in terms of, hey, we need to have a lot more transparency in terms of when are upgrades happening? Can we actually review all the upgrades? Can we actually also veto upgrades as well if there's some breaking changes, etc. And so, those are. It's more not necessarily around the core tech itself. It's more around the operations and management and the security of the technology that the questions are being asked
And
around.
do you think as an ecosystem are we being too slow on answering all the requests?
No, we've been preparing for this moment.
Okay.
Yeah, I just want to add, so for us, kind of everything has been mentioned, compliance, security, almost always the number one kind of question is around privacy and the various different privacy tooling. And the thing that we've heard again and again is, there's all these different options, various different L2s, various different protocols, what are the reference patterns? What are the playbooks? What are the ways to do this in a way that they're compliant, in the way that they are private? Different types of financial institutions or different types of organizations have different requirements. Like a fund manager is very different to a trading house, and they have different privacy kind of requirements because of that. And one thing that we're actually working on internally is that we are hoping to work with everyone in the ecosystem is creating a use case to privacy playbook for all the different types of, or at least most of the different types of institutional requirements.
One thing also that's unique is having to kind of educate them a little bit on the differences between an open source, fully permissionless protocol versus their own permissioned layer 2 blockchain. Right. The differences between those two sometimes do have to educate them because there are some nuances in terms of what is going to have a playbook, what is going to actually have a vendor risk management versus what is, no, this is just open source, completely permissionless. There is no vendor risk manager, that kind of playbook for that. Anyone can come deploy,
And just to add on that, like also like technology readiness, like sometimes there are protocols that are great, but they're only really at like a POC level versus ones that are, you could deploy in production and 100 million users could use it. So I think things like that. And I think what's also important to recognize is that there are different levels of sophistication, right? Some organizations have been building on Ethereum for 10 years and they're extremely sophisticated, and others are not so much.
One last question. After Tempo and after ARC announcement, are we seeing like a tailwind of company enterprises similar to Stripe coming to you guys and saying, hey, since Stripe is doing this, we also want to do it and help us create like a competitor or like, like our shield against what they're building?
I definitely think that's possible. One of the good things is that a lot of these blockchains will share the same underlying tech stack, and as long as they're open source, we can take some of the features. Like I know that Circle's chain is going to be built with Ref, the Rust Ethereum client, and the OP stack also supports Ref. So what this means is all of the code that is written for Circle's blockchain, we could in theory pull it into the OP stack, assuming that it's open source. They don't put like some sort of proprietary license on it. So if there is demand for these features and they really take off, then without a doubt, the Ethereum ecosystem can copy them and pull them in.
Now, I would say it's interesting because there's still like Stripe's a very unique position, right? They've had a large crypto team for quite some time. They're very sophisticated on payments technology, APIs, etc. So there's also a little bit of selection bias. Okay, that's Stripe. There's maybe a handful of other companies that can consider them almost like the same level of sophistication, understanding of both the payments world as well as the blockchain world. I think what we see generally is at the enterprise level, there's a lot of question marks by teams of, do we even need a blockchain? Or do I just need a blockchain application? I need to decide where to deploy. But then there's obviously clearly enterprises, especially on the banking side, where it's like, no, I actually need my own blockchain because I have such stringent requirements on who I can transact with, who can see my data, et cetera. Even if it is a small use case, it doesn't matter. I need my own thing. So I don't think it definitely raised, the recent news with Tempo, et cetera, has definitely made a lot of people think about their strategies, whether they're going the right way or the wrong way, or like where they should be swimming. But in a very rapidly growing and changing industry like this, I think there's constantly going to be, if you're at a large corporate, there's going to be constantly things happening almost every other week. They're going to have you do like a war room session for a couple hours and be like, is our strategy still the right strategy or not?
So yeah, thank you for the great question. Yeah, so unfortunately, that's all the time that we have today. As we close, I'd like to thank you, our panelists, Mo from Ethereum Foundation, Omar from ZK Sync, and Mark from Optimism, for sharing their insights. And of course, thanks to all of you in audience for joining us. I think today's discussion has highlighted both the common ground and the differences, whether it's about how we define an institutional-friendly layer, the role of decentralization, or the practical steps needed to meet regulatory and market expectations. We hope this conversation gives you a clear view of where blockchain infrastructure is headed and what it will take to make it truly institutional ready. Thank you.